PSA shareholders, they had received shares of FCA. So from a formal point of view, it's FCA that acquired PSA. But from the substance point of view, it's the opposite. It is PSA that has acquired FCA. And this is quite clear if you look at the composition of the board of directors. Out of 11, 6 are from PSA. So it's PSA that control and acquired the control over FCA. Okay, Claudio? So it's a matter of form and substance. From a one point of view, from a perspective, if you look at the form of the transaction, the journalists are right. But from a substance point of view, they are not. Maria has a question. Provide more information about the group work and the requirement, I suppose, for the presentation. Okay, next Friday, starting from 2 o'clock, you will present and discuss your project work. By this evening or maximum Monday morning, we will publish the schedule, 4 groups each hour, starting from 2 o'clock. Of course, if possible, since probably most of you will be here for the exam in the morning, if possible, it is better to be here in presence to present, not for us, but for you, because it's easier for you to manage the presentation and so on. But if for any reasons, 4 components, for example, are here and 1 is connected, it's not a problem. Okay? You will have 10 minutes. And as I told you yesterday, if I'm not wrong, you need to use from 9 to 10 minutes. So it is not a good idea to prepare yourself in order to present for 6 minutes, but it's the same, a bad idea to have a too long presentation that requires 15 minutes. Because during the presentation, I will use my iPhone. I will start the timer. At the 10 minutes, the timer will ring, and there will be, and at that time, I will stop you. Okay? This is very important because this is for not only for us but also for the other groups. Okay? So as I just told, the viola is not the problem if all the members of the group or just 1 or 2 are online. You can. Members that are here, they speak in presence, and members that are at home, they can use WebEx. It's not a problem. It's just a little bit more complex for you, so it's why I suggest, if possible, to be in presence, if possible. If it is not, it's not a problem. 3 are here, 2 are at home, and what is important that the students at home have enough strong internet connection, and but the others, okay, so you didn't hear, it's not a problem, and enough good strong internet connection, and of course a microphone in order to be able to speak. 10 minutes, no more than 10 minutes. And you have to choose the topics that you want to discuss. If you have to present for 10 minutes, I can assure you that it's a very bad idea to have 25 slides. Too many. Too many. Because 25 slides for 10 minutes means that, okay, I don't consider 10 slides, I don't consider the first with the title and the name of the components of the group, and the last with thank you for your attention. Okay, I don't consider the first and the last, but in the middle, 10, 15 slides maximum. It depends on how you decide to construct the presentation, but for sure 25 slides are too many. It's impossible for you to use 25 slides. Okay? So you need to make a choice. You cannot present all the topics discussed together. You need to make a choice because it's better to discuss and to present only 2-3 topics instead of presenting 8 topics in a very fast way, and you speak very fast because you need to finish the presentation. It's not a good idea. Okay? It's Friday afternoon, it's necessary to joke also, but it's a very important message. Okay? These are my... there are no other requirements. You need to upload your presentation. There is a deadline.
At 8 o'clock.
At 8 o'clock on Thursday, if I'm not wrong, because in this way we are able to download all the presentation. Okay? And in this way, you are not allowed to use here your presentation because all the presentation must be uploaded through Moodle. So we download the presentation in a single directory, and so in this way we don't waste time in changing the presentation, the driver, and second, in this way, all the students are in the same condition. Otherwise, students that present at 4 o'clock can change something after they listen to the others. So you are not allowed to use a presentation other than the presentation uploaded by Thursday at 8 o'clock p.m. 8 o'clock p.m. because in this way we have the time to download everything.
So every member of the group, we need to upload the documents.
No.
We just choose one.
Just one upload. One member of the group has to upload just one presentation.
Thanks.
Okay, just one presentation. And moreover, please write clearly your surname and name in the first page of the presentation so that we can verify that in our database the name of the components in our database is exactly the name and surnames of the components of the group. Okay? I don't have any other suggestions. Any other question? Okay. We can move to the consolidation. Consolidated financial statements that I need to share. Consolidated means that now we look at a group, okay, where there is a parent company and subsidiaries. I hope you remember that during the first lecture we discussed the difference between consolidated financial statement and individual separate financial statement. In the individual separate financial statement, assets and liabilities are only assets and liabilities of the legal entity. In the consolidated financial statement, there is the picture of the whole group, considered as a single big company. So, when we have to prepare the consolidated financial statement, we need to take into account two different timing. There is when the parent company buys a new subsidiary, at the end, this is a business combination. Okay? So when the parent company buys the shares of another company, the subsidiary, from the group perspective, this is an acquisition, a business combination. Okay? So at the end, also in the consolidated financial statement, we need to apply IFRS 3. We need to determine the consideration paid. We need to identify assets and liabilities acquired, measure them at fair value, and we need to recognize the goodwill, if any. So the starting point is exactly the same. At the end of each reporting period, then it is necessary to put together the financial statement of the parent company and the financial statement of the subsidiary. Unfortunately, it is a little bit more complex because when there is a merge, for example, UBI now no longer exists. Assets and liability of UBI are within Intesa Sanpaolo. So we have only one legal entity. FCA, PSA, now Stellantis, all the assets and all the liabilities are within Stellantis. When there is a group, the situation is a little bit more complex because the legal entities, they survive. So from a legal point of view, there are a lot of companies and they continue to prepare their individual financial statements, but when the consolidated financial statements are prepared, we need to put everything together. But having in mind the purchase price allocation done on the first day of when the acquisition is made. Do not worry that now we will discuss together an exercise. So we have a parent company that has one or more subsidiaries. The subsidiary is an entity controlled by another entity, and the consolidated financial statement is the picture of the whole group because investors are interested in knowing the situation of the group. According to IFRS, the control is defined in IFRS 10, and the definition of control is quite difficult to understand because it's a very general definition. We read now the definition together. An investor controls another company, the acquiree, when it is exposed to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. IFRS 10, if I'm not wrong, was issued in 2010, something like this. And I'm honest, when I read for the first time the definition of control, I thought, okay, I have to read it again. Okay? This definition is a very theoric definition, a very high-level definition, because the goal of IFRS 10 is to provide a definition so large, so able to capture all the different ways of controlling another company. So, read again. An investor has the control when has the power over another company, the investee. So just to new slide, just to use it to together. So here there is the investor. Okay, here this is the investor. Then we have another company, that is the investee. Very generic name, because the objective of IFRS 10 was to give, I repeat again, a very wide definition of control, able to capture a lot of different situations. The investor has the power over the investee. Okay, so the investor needs some instruments in order to exercise the power. In most of the cases, the power is exercised through the voting rights. So the investor has voting rights, that is, in most of the cases, shares. So voting rights, shares, and thanks to the voting rights, the investor has a power over the investee. So, if the investor owns, for example, 100% of the shares and of the voting rights of the investee, the investor has the power on the investee. Go back to the definition. An investor is exposed to variable returns from its involvement with the investee. The investor made an investment in shares. The investor buys the 100% of shares of the investee. If you make an investment, you expect a return. You agree? But in this case, you don't know. You don't have the right to a fixed return. Because your return depends on the business of the investee. Depends on the capability of the investee of generating net profit. If the investee is not able to generate net profit, but also only net loss, for you it's not so good. Do you agree with me? So, the investor makes an investment This investment allows the investor to have the power over the investee. If someone makes an investment, the objective, the final goal is to have a return. But this type of investment does not generate a fixed return. When you buy the shares of a company, you don't know how much the return will be, because it depends on the net profit and the net loss that the company acquired is going to generate. Variable returns. Okay? So, the investor has the power over the investee and, and the investor expect returns that are variable, not fixed. But, go back to the definition. So, the investor is exposed to variable return, not fixed. And the investor is able to affect these returns through its power over the investee. So, I have 100% of the voting rights of company B. Having voting rights means that I have the power on the investee. This return generates this investment generates variable returns, because we don't know if the company acquired will generate profit or loss. But I'm finally responsible for these returns, because if I control the investee, I can decide, for example, the strategy of the investee. I can appoint the board of directors. I can appoint the key manager. So I can affect the activity of the investee, and by affecting the activity of the investee, I'm able also to affect my returns. Is this clear for everybody? The definition is very, very complex, because it is in some particular cases, it is possible to control another company also without voting rights. HNT, without voting rights. So it is possible to exercise the control in a lot of different ways. But at the end, in the 90% of the cases, the control is exercised through voting rights, that is shares at the end. Okay? And this means that the definition is a very theoretical definition, and I can assure you that I don't ask you at the exam the definition of control. It's not my goal. The message is that voting rights, that is shares in other companies, can allow the company to control another company, because voting rights give the parent company the possibility to control, to decide the strategy, to appoint the board of directors, so to affect the activity of the subsidiary. You must only know that it is possible to control a company also without voting rights. And this is the reason for this so generic and theoretical definition. the previous standard, the standard that was in place before IFRS 10, control was only linked to voting rights. Now, it's not. But, at the end, in most of the cases, control is linked to voting rights. Okay? And, generally speaking, control exists when the voting rights are higher than 50%. Because generally speaking, if a company holds more than 50% of voting rights, this is enough in order to affect, to control the other company. Because in the shareholder meetings, if I have more than 50% of voting rights, I can decide. I can appoint the board of directors, the directors. I can approve the business plan. I can appoint the key managers and so on. Is this clear for everybody? But there are some particular situations where even if the voting rights are lower than 50%, it is possible to control the other company. For example, with a 40%. Do you have any idea on why this is possible? So, I have only 40% of the voting rights of the investee, but this 40% is enough in order to control.
Maybe the others have also less than mine.
Maybe the others are?
Have the voting rights is less than mine. Maybe 10% or 5%. So I'm the biggest, already the biggest one.
So I am the biggest one. Okay, I am the shareholders that owns the highest level of voting rights, like also AXA wrote in the chat. Okay, and this is not enough by itself, but we need to take into account that if this company, for example, is listed, the others, not only I am the shareholders with the highest number of shares, but the others, if the company is listed, the others, they have an amount of shares that is less and less compared to my 40%. Maybe the second shareholder holds, 8%. Moreover, keep in mind that when the shareholders meeting is called, in the first call, in order to make decision, it is necessary to have the majority of the voting rights. So 40% is not enough. But in the second call, decisions are taken having regard the majority of the voting rights that are present. So when the company is listed, a lot of shareholders don't attend the shareholder meetings. And so with my 40%, during the second call, I can decide, because I represent always the majority of the shareholders that attend the meeting. Is this clear? I will give you an example. Exxon is the company held by the Agnelli family, mainly, not only, but mainly. Exxon has the investment in Stellantis, but also the investment in Ferrari, the investment in CNH. CNH is the industrial part of the company that manufactures industrial vehicles. Okay. Exor owns only, if I'm not wrong, something more than 30% of Ferrari. But Ferrari is considered to be controlled by Exor because Ferrari is listed and 30%, something more than 30%, it's enough in order to control. Is this clear for everybody? But it is true also the opposite situation. That is a situation where the voting rights are, for example, 80%, but they are not enough in order to control. Do you have any idea why? Any ideas? This means that probably there is just another shareholder, just one, with the other 20%. We have an agreement, okay? And in this agreement, there is written that even if I have 80% of the voting rights, I have the right, for example, to appoint 3 directors out of 6. And with 3 directors out of 6, I cannot control. Okay? This is a common situation in the so-called joint venture. In this case, this company is not a subsidiary, but it's a joint arrangement. I mean, it's a jointly controlled company. So it's not controlled by the company, by the investor, but it's controlled together someone else, together a partner. Because if I have the right to appoint 3 directors, and the other shareholder has the right to appoint 3 directors, keep in mind, if the number of the director is 6, in order to take decision, they need to agree. If they don't agree, it is not possible to take decisions. So it's a particular structure designed in order to oblige the 2 partners to agree on everything. So even if I have 80% of the voting rights, I don't control. To be more precise, I have a jointly controlled together another partner. Okay? So for our purpose, it's important for us only the control exercised through voting rights, okay? Not the other particular situation. You must know that it is possible to control with the percentage of voting rights lower, less than 50%, and in very particular situation, it is possible not to control a company even if the voting rights held are more than 50%. Okay? A very particular situation, and so now we are able to understand also the meaning of non-controlling interest. Non-controlling interest means that an entity has the control over another entity, the subsidiary is not wholly owned, but there are some other shareholders. Consider this situation. This is the parent company. This is the subsidiary. And suppose that the voting rights are 80%. Okay. No particular agreements, clauses, and so on. So the parent company is able to control the subsidiary. But if the parent company has the 80% of the voting rights, this means that there are other shareholders that we don't know if just one shareholder or many, it doesn't matter, but together they have the remaining 20%. These are shareholders of the subsidiary, but they do not control. Do you agree? They do not control the subsidiary because the subsidiary is controlled by the parent company. In the accounting language, these other shareholders are called non-controlling interest. Okay? Non-controlling interest because they are in shareholders that do not control the subsidiary. Non-controlling interest. This is clear? In the past, they were called minorities. Because in this case, 20% is a minority. Okay? But it's better to use non-controlling interest because, like in the case of Exxon has something like 30% of the subsidiary, and this 30% is enough in order to control Ferrari. So this means that all the other shareholders altogether, they have 70%. They are no controlling interest, but as you can see, as you can imagine, it's not a good idea to call them minorities because they don't represent the minority, they represent the majority of the company, of the shareholders. However, they do not control. Okay? This is important for the consolidated balance sheet and income statement. Now, preparing the consolidated statements, financial statements, not only financial balance sheet but also income statement, it's not difficult but complex because the legal entities, they continue to be separate from a legal point of view. This is the key point. So in some companies, in some group, the subsidiaries, they are in the numbers of thousands. So putting together all the subsidiaries is something that is not so easy. It requires a very detailed process in order to put everything together. But what is for sure, we need to start from the beginning. So at the date of acquisition, it is necessary to apply the purchase price allocation IFRS 3 So the same analysis that we have just conducted. Then, once the acquisition is done, starting from that particular date, we need to put together the different financial statements. We need to eliminate all the intra-group transaction, and the consolidated financial statements must be prepared, summing up together all the assets and all the liabilities, all the revenue, all the costs of the subsidiary and parent company. So the process is quite complex because we start from the individual financial statements, and then at the end of each reporting period we need to sum up everything, and we need to eliminate all the intra-group transaction. I think that probably it is more difficult to explain this process in theory than applying it in practice with some cases. And so we can start immediately with an easy case in order to prepare your first consolidated financial statements. Suppose that always January year 1, company A acquired 100%, so we start from the easy case of shares of company B. So it's a little bit different compared to the previous case, because in the previous case company A bought the assets and liabilities of B. Now company A acquires the shares of B, so B continues to exist as a separate legal company. But starting from 1st of January year 1, B becomes a subsidiary of A. So we need to analyze the balance sheet of B at the acquisition date. Because keep in mind that when a subsidiary is acquired, at the end this is a business combination, and so we need to apply IFRS 3, so we need to apply the purchase price allocation and everything. So the balance sheet at the acquisition date, in the balance sheet of B, the assets and the liability are presented at their book value, or if you prefer carrying amount, it's the same. Okay? And suppose that the breadth is 0, then there are other assets, everything put together, for an amount of 2,000. All the liabilities for an amount of 1,500, so that the equity is equal to 500. Okay? Then the group has just made an acquisition, so we need to apply IFRS 3. We need to determine the fair value at the acquisition date of all the assets and liabilities. just not to make the exercise too complex, we suppose that the only asset that has a fair value different compared to the carrying amount is the brand. For all the other assets and liabilities, the amounts are the same. Just to understand the mechanism, because it is not, the mechanism is always the same. So the equity at fair value is equal to 900. So this is the, as we did before, this is the fair value in net asset. We need to understand the amount paid. We need to know better the amount paid and the consideration paid, so the purchase price, suppose it's equal to 1,200. Okay? So the procedure is always the same. If the fair value in net asset is equal to 900, the difference of 300 is what?
Goodwill.
Goodwill. Okay? Is this clear for everybody? This is what we need to do at the beginning. If you want, we can prepare the consolidated financial statement at the beginning, and we can do this. Of course, in order to do this, we need to have the information about the balance sheet of A. Here. Balance sheet of A as at the acquisition date. And pay attention. In this case, A doesn't buy the assets and the liability of B. A buys the shares of B. So this means that in the balance sheet of A, we have the investment in B. That is the shares, the 100% of shares of B. Is this clear for everybody? Because A doesn't buy the single assets and liabilities like in the previous case. A is buying the shares. So in its individual financial statements, we have the investment, and the investment is equal to the amount paid for the shares. Is this clear for everybody? Then suppose that there are other assets for 4,000. Then liabilities for 3,200. So the equity of A is equal to 2,000. Okay, this is the equity of A. This is the equity of B in its balance sheet. Is this clear for everybody? Now, we need to put together, when we prepare the consolidated financial statement, this is the key point, we need to put together A and B, considering the group as a big company without the separation due to the legal entities. And so when we prepare the consolidated financial statement, yes, of course, now we will see how, but we need to consider also the goodwill. So financial statement, to be precise here, it's only the balance sheet as at January the 1st. Okay, so 1 second the acquisition, 1 second after the acquisition. Look, in A, we have the investment of 1,200. In B, there is the equity. But if we consider the A and B like a single big company, without the separation of the legal entity, it doesn't make sense to maintain neither the investment in B nor the equity of B. So when we prepare the consolidated balance sheet, the investment in B is eliminated. It's better, I write this just in order to, like a reminder, that it's a mistake, a big mistake, to present the investment in B in the consolidated financial statement. Because in the consolidated financial statement, the two companies are presented as a big single company. So it doesn't make sense to present neither the investment in B nor the equity of B. We need to put together all the other assets and all the other liabilities. So assets, we have the brand of B as determined in the purchase price allocation. We have all the other assets, that is the asset of A plus the asset of B. And in this case, 4,000 plus 2,000. As some of you have just written in the chat, we need to consider also the goodwill. And the goodwill was 300. Okay? So the total assets in the consolidated financial statements are equal to 6,700. Then we have the liability. And the liabilities are the liabilities of A plus the liabilities of B. That is 3,200 plus 1,500. Okay? Now please look at the equity. The equity is of course the difference between total asset and liabilities. 2,000. Look, it's not the case. This is the equity of A, the equity of the parent company. The equity of the subsidiary is eliminated, is not presented. It doesn't make sense because here we are looking at the balance at the group as a big company without legal entities. And if the legal entity does not exist, the equity of B does not exist. So only when a business is conducted through a legal entity, we show the equity. Otherwise, we have simply assets and liabilities in the balance sheet. Please wear the mask. Thank you. Okay, is this clear, this first step? This is at the acquisition date. Okay, this is at acquisition date. Now, we need to continue, because if the group is formed, then during year 1, A and B, they put in place many businesses, many transactions. They have an income statement. They change assets and liabilities. In one word, they generate profit or loss. Okay? So now I present the balance sheet and the income statement of A and B, but at the end of the year 1. So balance sheet has at 31st of December, year 1. A and B. I repeat again, this is not like the merge of Intesa Sanpaolo and UBI or Stellantis, where the legal entities no longer exist. Here, unfortunately, for drawing up the consolidated financial statement, A and B continues to be two different companies. They continue to prepare their own financial statements. And we know that in A, we have the investment in B that is still there, always at the initial amount. Where are you here? 1,200. Of course, this is not present in the balance sheet of B. Then keep in mind that the brand is not recognized in the balance sheet of B, because the brand for B is an internally generated brand. So B continues to not to show the brand in its balance sheet. Then there are all the other assets. Of course, we are at the end of the reporting period, so the figures are different. This is just an hypothesis. 5,300. So the total assets are 6,200 for A and 3,000 for B. Okay, there are liabilities, and these liabilities are 3,700 for A and 2,400 for B. So the equity of the two companies is 2,500 for A and 600 for B. Okay? Look, there is a difference in equity of A compared to the beginning, and the same for B. What is the reason for having an equity at the end of the period for both the companies that is different compared to the equity at the beginning of the period? What is the main reason?
Brand.
Brand.
Brands.
the main reasons. What is the, if we prepare the income statement, thank you, Emanuele, profits in this case, or loss, but it is not the case. So A and B, during the period, they have a lot of, they put in place a lot of transactions. They incur in revenues and costs, and in our particular case, they generate profit. Suppose that for A, revenues for year 1 are 7,500, whereas cost 7,000. So the net profit is 500. This is right because the equity of 2,500 is composed of the equity has at January the 1st, year 1, that is for A 2,000, and the net profit for year 1. That is 500 that we have just computed. Is this clear for everybody? Keep in mind, equity is the difference between assets and liability. Okay? If we want to analyze the origin of the equity, in this case, we have the equity at the beginning of the period plus the net profit for the period. And A generated a net profit of 500. Regarding B, suppose 2,800 of revenue and 2,700 of cost. So net profit of 100. And this is consistent with the initial equity 500 and net profit for the period. Is this clear for everybody? Now we have all the data in order to prepare consolidated balance sheet as at the end of year 1 and income statement for year 1. Step by step. We start and we can construct the consolidated balance sheet here. Or here, just to have it easy to compare. Consolidated balance sheet as at 31st of December year 1. First question, is the investment in B presented in the consolidated balance sheet? No. Is the brand presented in the consolidated balance sheet? Is the brand presented? Yes. At which value? At 400. For the consolidated balance sheet, keep in mind that the brand B is recognized at the fair value at the acquisition date, always. Okay? And this means at 400. Keep in mind that the purchase price allocation is done only once, and the brand is still there if it has and indefinite useful life, the brand must be tested for impairment at the end of each reporting period. If the impairment test does not evidence any losses, the amount is always 400. Do you have any question?
Yeah, I wanted to ask why we don't recognize the investment on our consolidated balance sheet.
You would like to know why we
Yes, why we do not recognize.
the investment in B, because here we are preparing the group financial statement. And when we prepare the group financial statement, we suppose that the two companies are not legally separated. And if they are not legally separated, this means that when we prepare the consolidated financial statement, we need to eliminate, on the one hand, the investment in B, and on the other hand, we need to eliminate also the equity of B at the beginning when the group was formed. Because the equity of B exists only because B is a separate legal company. The same, the investment in B exists only because B is a separate legal company. When we prepare the consolidated financial statements, we make an hypothesis. What if the two companies, instead of being separated, were just one big company? And if there is just one big company, the investment doesn't exist, and the same for the equity of B. Okay? Now, if we go until the end, we can compute and all the figures. For Viola, now we are at the end of the reporting period. So during year 1, B did a lot of transactions. Okay? A lot of transactions. So this is the balance sheet of B on 1st of January. So 1 year after, trade payables can be different. Mortgages can be different. The same for the liabilities toward governments for taxes or liabilities towards employees. So this is the balance sheet at the end of year 1, 1 year later the acquisition. So assets and liabilities are different. Okay? Now, so Brent 400. Keep in mind, the purchase price allocation is done only once. And if we, due to the purchase price allocation, we determine a goodwill of 300, the goodwill must be reported in the consolidated financial statement. And the goodwill is still there unless, due to the impairment test, is eliminated, is impaired. Okay? But without impairment, the goodwill is still there. Then we have all the other assets, that is the asset of A plus the asset of B, and we have 5,000 and 3,000. So 8,000 of other assets. So the total consolidated assets are equal to 8,700. liabilities. And we have the liabilities of A plus the liabilities of B. Of course, the liability at the end of the period. Okay, so 6,100. Okay? Now, for sure, the consolidated equity is the difference between total asset and liability. Now, we need to check if everything is right. Because the consolidated equity is the equity as at 1st of January, year 1. But pay attention. Look, the equity was at the beginning only the equity of the parent company, because the equity of B, the subsidiary, was completely eliminated. So only the equity of the parent company. Then we need to consider the consolidated net profit. And this is year 1. The group has been formed starting from 1st of January, year 1. During year 1, the group is formed. So the net profit of the group is the sum of the profit of A plus the profit of B. So A plus B. And in particular, 600. Okay? And it works, as you can see. But are we sure? We need to prepare also the consolidated income statement for year 1. We have revenue income statement that are revenue of A plus revenue of B. Cost that are cost of A plus cost of B. So revenue are equal to 10,300. Costs are equal to 9,700. And the consolidated net profit is, of course, 600. And it works because, of course, the net profit shown as the last line of the income statement must be then reported in the equity, and everything must be balanced. If it doesn't match, if it is not balanced, it means that somewhere there is a mistake. Is this clear? This is your first consolidated financial statement. I don't see so much enthusiasm for this, probably because it's a Friday 5 o'clock. Probably because you need to review everything.
Yes.
But this is a business combination. It's exactly like the other case. But when the business combination is done by the acquisition of the assets and the liability of all emerge, then it's easier Unfortunately, when the legal entities remain separated, it is more complex. So the purchase price allocation is always the same procedure. The problem is that, as you can see, look at B figures. B figures are not affected by the purchase price allocation. Neither A figures. This is the problem, because the individual financial statements, they are not affected by the purchase price allocation. It is necessary to take into account this information in some way. As you can imagine, if we have only 2-3 subsidiaries, an Excel file could be enough. But if you have 500 subsidiaries, and this is not year 1, but this is year 10, if you want, you can manage it through Excel, but good luck. Because it's for sure that when you come to the end, it doesn't match, for sure. So companies, they need specific information system tools in order to put together the individual financial statements and to memorize all the adjustments that it is necessary to do in order to take into account the purchase price allocation. But not only, because here in our exercise we don't have any intra-group transactions. But when there are intra-group transactions, it is necessary to eliminate them. And with 2 subsidiaries, the Excel file could be enough. With 500 subsidiaries, it is not a good idea. Enrica, the case of Montclair and Stone Island is like this case. Okay, so Montclair bought the shares of the company that owned Stone Island. And so it's a subsidiary then of Montclair. Just a last thing. Consolidated. I didn't take note of the page, but somewhere there is the list of the subsidiaries. Here the scope of consolidation, okay. This is FCA, and pay attention, they are not all the subsidiaries, but only the main subsidiaries of FCA. Okay. And as you can see, there are subsidiaries in North America, in South America, Brazil, Argentina, in the Asia, in Europe, okay? And these are only the most important. Okay? So this is the consolidation, scope of consolidation of FCA. Here you can see the country and the percentage interest held. As you can see, most of the subsidiaries are wholly owned. But there is here a subsidiary that is not wholly owned. This is the FCA Serbia. The interest held here is only 66.67%. Okay? So next Monday we will discuss how to take into account the presence of the non-controlling interest. And since also the question of your colleague. We will also read Moncler financial statement in order to analyze the acquisition. But in order to analyze the acquisition, we need the semi-annual report because the acquisition was performed in the spring 2021. Okay? Okay. Very good. I'm going to upload the Excel file. Have a nice weekend, and we'll see next Monday at 8:30.
Bene, benissimo.
Yeah? Because we exactly.
Per farmi il lavoro di gruppo c'è una cosa che non mi è chiara nei tagliati.
Più modi per consolidare in questo caso eventualmente magari dall'anno 2 prima era una situazione che fatto da una ieri così c'è andata una percentuale di acquisti bisogna mettere
Non è una cosa ok. Invece una cosa che riguarda l'esercizio dell'esame, che simile a e io inizialmente l'avevo fatto per non tenere conto avete guardato due, però aveva detto che prima di fare il tema e quindi come verrebbe uguale, quindi
il valore finale non è uguale, il problema è che se voi non scrivete l'ammortamento dell'anno vi verrà la svalutazione anche l'ammortamento dell'anno che calcolate, quindi guardate che
no, nel senso che poi mi chiede qual è la formula del 28 dell'anno, e io non tengo conto dell'assestamento dell'anno 2 mi viene che c'è una perdita di 100.000, ma se io tengo conto mi viene che
allora, poi non capisco
我也想整一下我在哪。
再加一下他，
怎么样？联络给
问一下你们两个。
attenzione, la svalutazione comprenderà anche la cosa dell'ammortamento che non avete calcolato. Veramente la svalutazione
哦，你刚才说完，刚才我是不是把你打断了？你先把这个终止了。
però
哦哦，哎，还没终止。